In their recent annual report, the BIS offers us 3 potential economic scenarios for what we can expect over the course of the coming year. I find this intriguing as their data and their insights are fundamental for central bank preparedness or not across the world. So let's dive on in and explore this. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Now, every other month the BIS hosts a global economy gathering which brings together 30 central bank governors from the major advanced and emerging market economies that account for around 4/5 of the world's GDP. Moreover, the BIS, as the effective central bank of central banks, offers us some key insights as to what we may expect in our economic future. And so in their 2021 annual economic report, they offer us 3 compelling scenarios. The first is what they consider to be their central scenario, that the economic recovery should continue but will vary in pace across different countries. In this scenario, they anticipate that among advanced economies, or alternatively, the most heavily indebted nations, with the exception of Germany, if that's what constitutes being advanced, the US will lead the recovery, as we can see in the chart on the left here, while the UK will be the laggard. In emerging markets, China will lead the recovery, followed by Turkey and India, as we can see in the central chart, while they anticipate that inflation will move closer towards central bank targets and in some cases exceed them. But reassuringly, they comment that inflation overshoots are seen as temporary. Being central planners with beliefs rooted firmly in Marxist Keynesian ideologies, the BIS believes that accommodative fiscal and monetary policy are envisaged to underpin the recovery. This will consist of the Build Back Better fiscal fallacy and ultra-loose monetary policy. The BIS believe that this monetary policy will continue until inflation meets or exceeds central bank targets. But with national debt levels so high, will the inflation rates be massaged downwards? This would seem highly likely to me. Meanwhile, this scenario also highlights the potential for advanced economies with high vaccination rates to make a Pandexit, an economic exit and recovery from this nearly 18-month hiatus. While the BIS perceive this as their central scenario, I believe that their last scenario seems most plausible to me. But let's firstly just consider their second scenario they outline. Now, this is very much a stagflationary outlook where inflation would run hot across a number of countries. The consequence would be for a tightening of monetary policy to begin to take place. This inflationary impetus would largely originate from demand pull pressures, courtesy of the rundown of excess savings that have taken place across previous lockdowns. In addition, it would assume an initially high fiscal multiplier effect, i.e. a high proportional increase in GDP courtesy of enormous government expenditure and vast fiscal transfers. This would fuel further demand for imports into the US, and demand pull inflationary pressures would grow, prompting the need for a further tightening of interest rates. Yet the BIS confess that one cannot rule out a larger and more sustained increase in inflation, while the forecast goes on to state that even a temporary rise in inflation could deliver a sizable financial tightening, especially given stretched financial markets. This would be more likely if uncertainty about central banks' responses caused financial markets to bring forward the anticipated start of policy normalization, and with that, slowing growth, of course. But unquestionably, the most detailed forecast that the BIS offers is for their alternative scenario 2. Here, recovery stalls, businesses' insolvencies rise dramatically, which would have a significant negative impact upon banks as corporate loan losses would rise. In turn, bank lending capacity would be hammered, limiting the ability of startups to actually gain access to capital. Now, what could possibly cause such a situation? What could be the trigger? Well, the BIS highlights an adverse turn in the pandemic, as the BIS states that a particular risk comes from the emergence and spread of new vaccine-resistant virus strains from countries with high infection rates and slow progress in vaccination. They go on to state that modifying vaccines to cope with these strains would take time and renewed lockdowns could be required. Based on the historical relationship between infection rates, lockdowns and GDP, the emergence of a vaccine-resistant virus strain could lower GDP by between 1.5% and 3.5% in the second half of 2021, with regions where vaccination has progressed most experiencing the biggest hit to growth. Now, this seems very interesting and very much aligned with what we've seen in the news in recent times in various stories. Now, in this scenario, consumption would plummet and the fiscal multiplier would be negligible, given the desire for households to embark upon precautionary saving once again. But the impact on small and medium-sized businesses would be profound here. After almost 18 months of enormous difficulties, they would find it very difficult to actually get through this period. Now, this scenario poses a clear threat to the independent incomes of these small, medium-sized enterprises. And the paper highlights in the left-hand chart the sectors that would be most profoundly affected. Reading this scenario and applying it to what we have seen in the news recently really sent a chill up my spine. And the depth of detail that the BIS goes into for this scenario is fairly extensive. While the likely policy response would involve even greater expansionary monetary and fiscal policy. At the same time, emergency liquidity provision may be introduced for financial institutions and further support from central banks for corporate bond markets is likely to be implemented. Now, small businesses may be offered even more extensive credit lines, but taking on more debt at a time where these firms are experiencing massive declines in their income is not a recipe for success. Now, this policy response would have profound effects on asset markets, most notably the stock and housing markets, which have been on an utter tear in recent times. While the suppression of interest rates and bank interest rate margins, together with deteriorating bank balance sheets, would lead to a world of low profitability firms, zombie banks and stalled productivity growth. While in the longer term, the BIS continue to hold on to the fanciful notion of monetary policy normalisation. Now, many of you will remember what happened previously when the Fed tried to embark upon a quantitative tightening period and raise the Fed funds rate. Of course, it didn't end well. And now, with debt levels far higher and central bank balance sheets far more vast in their scale, it's really not a likely outcome at all. Now, as is often said, if you know the outcome, you know the journey. I cannot help but feel that the second alternative scenario is by far and away the most plausible for what we are likely to see in the developed world over the next 6 to 12 months. Meanwhile, those red states will continue to do their bit for freedom, and what a significant role they play in the world we live in today. Now, I desperately hope that we actually see a dramatic recovery and things can normalise, as of course everyone does. But I cannot help but feel that we are likely to see a spanner thrown in the works here. And that second alternative scenario that we've outlined there really does seem very plausible with what we continue to hear almost on a daily basis if you do actually follow the news. Now, thanks ever so much for joining me. Let me know your thoughts. Please watch out for scammers there in the comments, and do remember to check out the free speech platform Odyssey, for which there's a link in the description. I look forward to seeing you next time. Bye bye.